Hey guys, this is the second episode of Technical Tip Tuesday, and today we're going to go over the MACD and go over applications, common examples of how to apply it, and when not to apply it. Last week we went over the RSI, and you can basically think of the MACD as the stronger older brother of the RSI. The MACD is it is an oscillator. It measures momentum. It tells you when bearish momentum is waning or when it's strengthening, and the same thing for bullish momentum. So if you're in a current bullish market, a bullish rally, it'll tell you if the upward move is likely to continue, and likewise, if you're in a downward market, it'll tell you if the downward move is likely to continue. We'll use the Ether USD market as our example here. So one thing to note, that when you're trading with the MACD, it's not really best in consolidation markets. It's mostly best for trending markets. If you trade in a consolidation market, which is, say you're in a you're in a sideways market, or maybe you're zoomed in really close and you're looking at this time frame right here. This can give you false signals in this area, and and likewise, if you're in a sideways market and you're kind of just like range bound, a market like this is not going to be very good for the MACD. So what you want is a consistent uptrend or a consistent downtrend, and that's where you're going to use the MACD. So the MACD, MACD stands for Moving Average Convergence Divergence. And what it's going to tell you is it's going to tell you, well, let's break it down. So the MACD is comprised of a histogram, which is this guy right here, and it's comprised of the signal line and the moving average, and that's these guys right here. Boom. So what these guys do, one is a 26 period moving average right here, and one is a 9 period moving average right there. So something else to note is that when you're looking at the MACD, you see that it can either be green or it can be red, and that kind of oscillates around this zero center line here, right? So if the MACD is red, this is considered to be a bearish period. Here's a period right here. This is considered bearish, and if the MACD is green, this is considered bullish. So let's go ahead and look at this example right here. This is a great trending market on Ether USD. You can see it's very obviously in a downtrend here. Let's go ahead and change the color. You can see it's very obviously in a downtrend. It's making lower lows. Boom, 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 boom. Lower highs here. And so this is going to be considered a little bear run from here to here. So let's go ahead and break down and let's see if it's likely to continue. Okay, so the first thing to keep in mind, if you haven't already seen the RSI video where I break down the basics of divergence, highly recommend doing that, and I'll post a link in the description below for the RSI, because that's going to be a simpler version of the MACD divergence. So quite simply put, divergence is it's going to show if the momentum is waning in a given direction. So if the market's moving down, we want to see if we're going short, we want to see continued bearish strength, and if we start to see bullish momentum starting to kick in and bearish momentum starting to die out, that is said to be bullishly diverging. So let's look at this example below, and let's see if we can spot some divergence here. Okay, so let's go ahead and look at the 5 minute. Yeah, 5 minutes got a great example right here. Okay, I'll zoom in a little closer. So with the histogram, first and foremost, we want to learn how to use the histogram. So the histogram is going to be used for a given period. So in this case, we'll look up here and we'll say, okay, here's the beginning of this histogram, Here's the end of this histogram. And we can see very clearly that during this little chunk of time, the price is going up, right? So we want to look down at this MACD, and if we enter a long position here, and we're trying to see if the price is going to continue upward, we want to look down at the MACD to see what the momentum is doing. So every time the price is making a new high, we want to see the MACD making a new high as well. And what we see here is, the price continues to make a new high. It rallies to about right here. What is this, about 312? And the MACD makes a new high. But what we also see is that as the price drifts upward after 312, the MACD does not make a new high. So this sort of price action where the MACD is trending downward, but the price is trending upward, this is said to be bearish divergence right here. This little guy, bearish divergence. Okay, let's look at another example here. So we see here, we got a new period here, and as the price is making new lows, the MACD is just like what happened on this histogram right here. The MACD is failing to make new lows as we're pushing new lows here. So this sort of price action right here is called bullish divergence. So if the price is going down, the MACD is going up. This is bullish divergence. And if the price is going up, but the MACD is going down, this is bearish divergence. So how do we compare an overall trend using the MACD? Okay, we broke down individual parts. We can look at it here. So one part, 2 parts. How do we look at the whole trend? So for that, we want to use the signal line and the moving average and look at that trend to see how we're trending overall. Okay, so if we want to look at the strength of this whole run right here, we're going to not look at the histogram, because the histogram is for individual periods. What we want to look at is the lows on the moving average and signal line. Okay, so just like the RSI, say if the price is going up and the RSI is trending upward, this is showing strength. And if the price is trending upward and the RSI is trending down, this is showing bearish divergence. Same idea can be applied here. So if the price is going down, which it is, right? It's going downward. What we want to see is every time the price makes a new low, we want to see new lows being made here. So we go down here, here's a new low, we see a new low, okay, cool. Go down here, we don't see a new low quite yet. Here's a new low right here, and you can kind of just check it out. So you see this descending trend along the moving average signal line pattern here. So every time the price is making new lows, well, not every time the price is making new lows, but as the trend goes downward, the MACD is making new lows. And what you can see right here is the price made a new low here, but the MACD is failing to make a new low as as we speak. So this is a potential bullish divergence right here on the MACD, because you see the price is going down, but the signal line is starting to move up. So this downward trend could be starting to find a local bottom right at the 302. That remains to be seen. But it's also important to note that that when trading on indicators like RSI or MACD, that they are not standalone indicators. They're just another tool in our toolbox to give us insight in the market. So you can kind of imagine that as the price makes a new low and the RSI makes a new low, for example, and the MACD make a new low, that'll give firm strong support of a continued downward trend. So if the price is going down, the MACD makes a new low, the RSI makes a new low. This just gives us extra confidence that we've got two indicators showing continued downward trend, and vice versa, going upward. So the price is going up, and we see the MACD making new highs, we see the RSI making new highs. This is a great indication of a bullish continuation. Okay, so let's just go ahead and recap what we went over. So the MACD is an oscillator that measures momentum in the market. It lets you know the strength of a move, if the market is moving upward and it's continuing to make new highs. We'd like to see the MACD also making new highs. And when the market moves upward, it makes new highs, but the MACD fails to make new highs with the market, this is called bearish divergence. And vice versa, as the market moves downward and the MACD starts to fail to make new lows, it starts to curve upward, this is called bullish divergence. Also, something to note is that when using the histograms are only valid for a given period. They're not valid for the whole trend. So when you're comparing peaks, don't use the histogram. Use the signal line and the moving average for the overall strength of the downward move. So that wraps up Technical Tip Tuesday. If you liked what you heard and you found it useful, feel free to drop me a like on YouTube. Share it with your friends. And if you want more information outside of the Technical Tip Tuesdays and you'd like to join the Discord network, those links are available in the description below. And yeah, as always, thanks for your support, and I'll see you next Tuesday.